Hi, I'm Ross from Smith Property Accountants in Hamilton. I'm just going to speak today about using a two-bank approach when you're looking at transferring your existing house to become a rental. So starting point with this is make sure you read my couple of articles that I've got on my blog about an existing house becoming a rental. The first point and the first thing I always look at is it actually a good rental property? Is your personal house actually a good rental? And often it's not. So it's really good to look at it as if what happens if you would sell your personal house and you'd go and buy another personal house. Would you rebuy your personal house as a rental? Is it actually a good rental property, and would you actually buy it if you had that choice completely from scratch, no emotional ties? Would you buy it as a personal house? So make sure you read that article, go through that information, and that will help you a little bit, but really think hard about that. Is it actually a good rental? To start though on the two-bank approach, what you often find is you go to your banker or your mortgage broker and they'll be like, nah. It's just easier to go with one bank. It's much simpler to go for one bank. Well, it probably is. But for you, in my opinion, it's better to have two or more banks. It's better to separate your personal house away from your rental property so that the two are with different banks. They have different control. If everything goes horribly wrong, you've got two separate banks to work with and try and work things through with. And also, as you gain more and more equity, you should both get your rentals completely separate. So just a quick disclaimer to start with, this is general information and not specific for you. So make sure you get specific advice from your mortgage broker, accountant, and banker, but this will give you a general idea. So just to start off with, we're looking at someone who's got a personal home worth $600,000. The debt is $215,000. This property is going to become a rental, and they're going to buy a new personal house for $650,000. So we'll start off with some tax. Obviously for tax, we want 100% debt on the rental. That means that all the interest on the loan is tax deductible, and that will be better for us for tax. So either result in less tax paid or a bigger tax refund under current rules, which are likely to change very shortly with ring fencing. A big thing, security doesn't matter. It doesn't matter what the loans are secured on. It's what the loan is used for that's important. For example, if the loan is used or money is loaned to an LTC to buy a rental property, then that should be tax deductible. So with my example, ANZ current personal house might be worth $600,000. We're looking to sell the LTC. So basically, it would repay the current loan of $215,000 from the sale. Cash left would be $385,000. So just look as if you're just selling the property on the normal market. You'd sell the property, you'd pay off the loan, you're left with so much cash. Then we're looking at buying a new personal house. We might do that through ANZ. Note, I don't care what banks you go with. This is just for example that I've used these two banks. So you'd buy your new personal house, $650,000. You've got $385,000 cash from the sale, so you'd bring that down, use that for your personal house, and be left with a $265,000 debt on your personal house. You then go to another bank, so BNZ in this example. You're buying the rental for $600,000, so you're buying this one. BNZ will generally lend 70% or $420,000 on a rental property. And for an example, if you were buying it in an LTC, that would be a loan to the LTC and the security would be over the rental property. But where do you get the rest of the money from? So ANZ again, they will probably lend up to 80%. So they'll probably lend up to $520,000. So that means if we're using $265 to buy the personal house, we've got $255 left. If we borrowed $180,000 and use that to help buy the rental, we're then up to the $600,000. So that would be a loan to the LTC, and it would be security over the personal house. And there'd be a small amount of equity left again. So basically we're buying with two different banks, BNZ lending up to the maximum and then borrowing from the personal bank to get the rest of the money across. So at the end of it, we'd have a personal house with a $265,000 debt from ANZ. The LTC would have two loans, one from BNZ that would be secured over the rental and one from ANZ secured over the personal house. Both loaned to the LTC, both tax deductible because they'd buy the rental property. So hopefully that's given you a few things to think about. And yeah, just if you are looking at doing this, really think about doing the two bank approach. If you have rentals, again, think about having two or more banks. It can really help protect you. And there's another video that I've just done on two bank approach to buying a new rental. So that might help you to go through that as well. Hopefully you enjoyed this. Thank you very much.